5%, so effective rate is 34.608%, which is now the maximum marginal rate. For corporates with income between 1 to 10 crore, surcharge goes up from 5 to 7%, so effective rate is 33.063%, and for corporates with income above 10 crore, surcharge goes up to 12%, so effective rate there also is 34.608%. The MAT rates are also again from 1 to 10 crore is now 20.389%, and above 10 crores is 21.342%. So it's almost 2/3 of the normal rate. I mean, in that sense, MAT is really going up. And dividend distribution tax again is now 20.358% of the actual dividend distribution, because that's something which is going to hurt a lot of shareholders, the higher dividend distribution tax. And interestingly, the dividend distribution tax comes into effect from 1st April 2015. But I think the question there is, by virtue of Section 2, since the Finance Act would not have been enacted till probably the middle of May, what does one do from the period from 1st April till, say, the Finance Act comes into force? What does one do? And there possibly one can rely on the provisions of Section 294 to say that whichever is more beneficial rate would apply, and therefore the old rate possibly would still be applied. Corporate tax rates, there's just an announcement right now saying that along with phasing of exemption, the rates will also go down by 5% over the next 4 years. So no change this year. The interesting thing is that wealth tax is now no longer applicable for assessment year 16-17. So therefore, those. But the problem is, of course, that you will now have to disclose those assets possibly in the income tax returns. There's already a disclosure which is there in the income tax returns for persons having business income and about income total income exceeding 25 lakhs. But there it's at cost. And now I wonder whether this will really serve the purpose, because what happens is, for instance, things like jewelry received by way of gifts typically where what then happens, the cost is nil in such a situation. So therefore what happens in those situations, or inheritance is received, the cost is nil. So do you record the cost of the previous year in your books, etc.? Those will be the questions which will be, particularly when you don't maintain books of accounts. So those will be the problems which one will have to deal with. The next project I would like to set up, provision I would like to deal with is those provisions relating to charitable trusts. The first amendment in section 215, as you know, 215 defines charitable purpose. And you had, of course, the Delhi tribunal decision in the case of Divya Yog Mandir Trust in 60 SOT 194, where the Delhi tribunal took a view that yoga is a form of education. So therefore, they held it as a charitable purpose. And then, in fact, this Divya Yog Mandir Trust was Baba Ramdev's trust, I think, and because they have all the sale of medicines, etc., and all that, and they said that this is certainly charitable purpose, and it was held eligible for the benefit of exemption. Now, what has happened is they've added it separately as along with medical relief, relief of poverty, any other, and education, etc. So it's a separate limb itself. So therefore, what would happen is, now it would not be regarded as advancement of any other object of general public utility. It will not fall under the residuary clause. If it does not fall under the residuary clause, the proviso to section 215 does not apply to it. And therefore, even if an activity is carried on which is in the nature of trade, commerce or business, or in relation to trade, commerce or business, it will not lose the benefit of exemption. So that is something which it ensures that there will be exemption available to trusts which are carrying on yoga, even if they are carrying on a business activity or an activity in relation to business. The other important change in section 215 in the definition of charitable purpose, as you know, today you have two provisos. One proviso, for the first proviso says that advancement of any other object of general public utility shall not be a charitable purpose if it involves the carrying on of any activity in the nature of trade, commerce or business, or in relation to trade, commerce or business, for a fee, cess or fee or consideration, irrespective of how that cess or fee or consideration is utilized. The second proviso says that if the receipts of such activity during the year do not exceed 25 lakhs, then the first proviso does not apply. So, if a trust is carrying on any activity in the nature of trade, commerce or business, and the receipt from that activity is less than 25 lakhs, it does not lose the exemption, it continues to get the benefit of exemption. Now the amendment is they have combined the two provisos, and what does it say? Of course, one is that in the nature of the activity, earlier it was activity in the nature of trade, commerce or business, or any activity in relation to trade, commerce or business. Now the second part it says any activity of rendering any service in relation to trade, commerce or business. So you are rendering a service in relation to trade, commerce or business. That's one aspect of it. Because earlier, the Delhi High Court in the case of GS1 took a view that in relation to trade, commerce or business means whose trade, commerce or business? Are you looking at trade, commerce or business carried on by the persons to whom you are rendering that service? Or is it the trade, commerce or business of the SSC itself? And he said two views are possible, but the better view possibly we take a view in favor of the SSC, that it's possible that yes, it applies to trade, commerce or business carried on by the SSC itself. So that I think is now, by this amendment, that part of it is now clear. The second aspect is they've clubbed the two provisos, and it says that it shall, irrespective of the nature of use or application of retention or income from such activity, unless such activities undertaken in the course of actual carrying out of such advancement of any other object of general public utility and aggregate receipts from such activity or activity during the previous year do not exceed 20% of the total receipts of the trust or institution undertaking such activity or activities of that previous year. So, if you look at the earlier position, the tribunals had taken a view, because I had taken a view that say we are letting out of premises. So you are carrying on an educational activity, you have a hall, and that hall is let out when it's not required for the educational purposes, for the students, etc. It's let out. That does not attract, because they said in that situation you're not carrying out a trade, commerce or business or an activity in relation to trade, commerce or business in that situation. And secondly, the question there was also that is, say for instance, a mere fundraising activity. If I carry on a trade, commerce or business, say I organize a premiere film show for the purpose of raising funds for my trust. Now that is not something which I'm doing in the course of carrying out my charitable activities. So is it, because if you look at the language of the main section, it says advancement of any other object of general public utility shall not be a charitable purpose if it involves carrying on of these activities. So therefore, in the course of carrying on advancement of any other object of general public utility, you should not carry on these activities. So that was the way the tribunals were interpreting. And now, of course, again this says such activities undertaken in the course of actually carrying on not such advancement of any other object of general public utility. I think this merely reinforces that of course, here they what they say is this is for the exemption part, unless this is carried out. Now, even I would say that even otherwise, the first main section itself, the section 215, the proviso itself, the main part of the proviso starts off with you should carry out that activity as a part of your advancement of any other object of general public utility. It would not apply to some other activity. That is where the other aspect, of course, is that when you talk about rendering of services, now you say rendering of services in relation to trade, commerce or business. So rendering of service has to be some active rendering of service. Possibly it would not be just something like interest. Now they have been decisions which say that earning of interest is actually in the nature of trade, commerce or business. Now earning of interest is not a rendering of a service, and therefore I think that would clearly be out of purview. So that's one of the so similarly the mere letting out of premises, again that would also possibly be outside the purview. And again, as I said, to my mind, fundraising activities would still not be covered. The real difficulty will be that smaller trusts, which would earlier getting the benefit of exemption under section of this 25 lakhs, they would now possibly be affected if their income from some of this activity is more than 20%. Say for instance, you have a trust whose gross receipts are only 30 lakhs, and say 10 lakhs is the income from such activity. Now that is more than 20%. So therefore, they don't fall under the exception, and therefore they will lose the benefit of exemption. Earlier, if that income was less, because the income was less than 25 lakhs, they were getting the benefit of the exemption. And this, I think, is a very unfortunate thing which is happening. Then, of course, you have those two pet projects of the Prime Minister, Swachh Bharat Kosh and Clean Ganga Fund. They have an exemption being given to the income of those funds. And the donations to these funds are exempt up to 100% under Section 80G without the 10% limit. But if these contributions are claimed as CSR contributions, then you don't get this 80G deduction of 100%, that's not available. There's one more fund to which a 100% exemption has been given, and that is the donation to the National Fund for Control of Drug Abuse. There also a deduction under 80G is 100% without any limit of 10% to the next amendment, so far as charitable trust is concerned, is the amendment in relation under the explanation 2 to section 11.1. As you know, the expression 2 to section 11(1) gives you an option. If you have not spent 85% of your income during the year, you have an option to spend it in the subsequent year. Now, that option could be exercised by simple filing of a letter. That was the position. And we had, of course, the Bombay High Court in the case of Tulsidas Gopalji Charitable and Charitable Temple Trust in 207 ITR 368, where the Bombay High Court said that even if you file a letter before the due date under section 139(4), that is good enough. It's not necessary that you file it before the due date of filing return under section 139(1). Now, this is substituted that instead of just an intimation in writing, it should have to be in such form and manner being described. So probably you will have a form which will be laid down for this purpose, and that form possibly will have to be filed online, just as you file your Form 10 and your Form 10B, etc. So that's the amendment so far as this expression to section 11(1) is concerned. The other amendment over there is in relation to accumulation in section 11(2). As you know, you have to file form number 10, and there was no time limit earlier laid down in section 11(2). But under the rules, the rule 17 provided that you have to file it before the due date of filing of return of income. There, the Supreme Court, in the case of Nagpur Hotel Owners Association, in 247 ITR 201, took the view that you can file it any time before completion of assessment, in the absence of any time limit which is there under the Act. So that was the view which was Supreme Court had taken. Now this is sought to be amended after many years after the Supreme Court decision, where the time limit is now coming under the main section itself. So therefore, that will now form part of the Act, and therefore the aspect which the Supreme Court took into account that the rule is ultra vires the Act, because where the Act does not lay down a time limit, how can the rule lay down a time limit? That was what the Supreme Court had taken the view. But the other aspect here is that whether courts will now read down this also to say that filing of the form is mandatory, the time limit is directly. As you know, under various other sections, courts have taken the view. In fact, the Bombay High Court, I think in Sivanand, the electronics case, in the context of, I think, ATI, had taken the view that the filing of the form is mandatory, but the time limit is a directory requirement. So possibly that is something which the courts may read it down, but right now the position is that one will have to file the form before the due date of filing the return under section 139(1). Not only that, if you don't file the form, you have a section 13 which is amended. You have a subsection 9 which is introduced. 13, as you know, points out when do you lose the benefit of exemption. And there they say that the 11(2) accumulation will not be allowed under two circumstances. One is if you do not file the form number 10 before the due date prescribed, that is before the due date of filing of return of income. Second alternative is if you do not file the return of income in time. So if you don't file the return of income in time, or you do not file this form number 10 in time, in either situation you lose the benefit of accumulation under section 11(2). So therefore I think it's very important that one takes this form, ensure that this form is filed at least well in time. But this denial of accumulation, fortunately, is only currently restricted to accumulation under section 11(2). It does not apply to your 15% under section 11(1)(a), nor does it apply to the option to spend in the subsequent year, which is under expression 2 to section 11(1). But if you look at the trend over the past few years, I think the government has been extremely uncharitable towards charitable trusts. I think charitable trusts are being treated worse than businesses, frankly speaking. I think if you look at the way they are being, and many of these charitable trusts really don't have the wherewithal or the infrastructure in place to comply, with it. And I wouldn't be surprised if in a future year it would be extended even to other things like this. That's the other area where there has been an amendment is in respect of filing of returns of income of charitable trust. As you know, you have a category of charitable trust under 1023C, which is 380 and 3AC, which is educational institutions substantially financed by the government, or hospital and medical institutions substantially financed by the government. Now, these are exempt without any conditions. There was no requirement of filing of the return of income so far. Now you have a requirement that they will also have to file the returns of income. So that is something which has come in under section 139(4)(c). So all government aided schools, colleges, etc., all of them will have to file the return of income. That's something which will and the other amendment related to charitable trust is in relation to appeals to the tribunal. As you know, under 1023(6), an educational institution having gross receipts of more than 1 crore, which is not substantially aided by the government, can seek approval under 1023C6 for exemption. That approval is granted by the Chief Commissioner. Similarly, a hospital also can, or medical institution can claim under 6A. That approval is granted by Chief Commissioner. Now, if that approval is rejected by the Chief, application for approval is rejected by the Chief Commissioner, currently the only alternative is to file a writ petition. There is no other alternative. Now they are providing appeals to the Income Tax Appellate Tribunal. But this is currently only for institutions under clause 6 and 6A of 1023C. Say for instance, you have charitable organization of national or state importance under clause 4. Now that still there is no appeal against those rejections yet. Similarly, religious organization under clause 5 of 1023C. So there also have the concept of approval, but there also now no appeal is yet provided to the tribunal. So therefore, in those situations, the only option is would be still a writ petition. Coming to the exemptions, you have exemption for the Sukanya Samruddhi scheme, the income from the Sukanya Samruddhi scheme. As you know, last year it was notified in January 2015, Sukanya Samruddhi scheme, and it was notified for the purpose of section 80C as well. So any contribution to Sukanya Samruddhi scheme was deductible under 80C. And now the interest income of a Sukanya Samruddhi scheme is also being granted exemption. In fact, I'm told that the interest rates are very attractive. It's 9.1%, as against the PPF interest rate of 8.7%, and therefore this will now be exempt income. But the language of it talks about section 1011A. It says withdrawals from the Sukanya Samruddhi scheme. So the doubt is, what about interest on Sukanya Samruddhi scheme? But if you look at the explanatory memorandum clearly provides that the interest would be exempt from tax. And similar language is there in clause 11 where PF, Employees Provident Fund withdrawals, similar language is there and where this has been accepted. Coming to the next point on business deductions, you have this concept of additional depreciation, and where you get an additional depreciation of 20% of the cost of the assets in the year the asset is installed and put to use. Now, what happens is, where an asset is installed and put to use, say during the second half of the year, and used for less than 180 days during the year, then the additional depreciation is also restricted to half, 50%, along with the regular depreciation. So the question was that, do you get it only in the first year, or do you get the balance in the second year as well? The balance additional depreciation of 10%, do you get it in the second year as well? And that was a matter of dispute in Bricks India Limited, 144 ITD 403. The Chennai Tribunal took a view that no, you don't get it. It's only in the initial year that you get it. You don't get it in the subsequent year. But there were 2 or 3 other tribunals in the Cosmo Films Delhi Tribunal, Apollo Tyres Cochin Tribunal, and MITC Rolling Mills, the Bombay Tribunal. These have taken the view that no, you will get the balance 10% in the subsequent year. Now the amendment is that yes, they have accepted the most of the tribunal's views and taken the view that you will get the balance 10% in the subsequent year. That is the question here is, what will be the impact on pending matters? Would this be regarded as clarificatory? I think it's possible to argue that yes, this is merely a clarificatory amendment, and the position always was that was the intention, and that intention is now brought up by the subsequent amendment. That is possible, I think, to take that view. That is, there is a first proviso which has been added to 31(2)(a) for units for undertaking set up after 1st April 2015 for manufacture or production of article of things in Andhra Pradesh or Telangana, where they acquire and install new plant of machinery other than ships of aircraft for the undertaking during the period from 1st April 2015 to 31st March 2020. There, the additional depreciation, instead of 20%, it would be 35% in those cases. And again, this 35% would be subject to at 50% in the first year, 50% in the second year, if it's in the latter part of the year, in less than 180 days during the year. Coming to investment allowance under section, you have a new investment allowance for units set up in Andhra Pradesh and Telangana. You have, as you know, 32AC already provides an investment allowance. Now you have another investment allowance under section 3280, which provides for a deduction of 15% for an undertaking set up after 1st April 2015 for manufacture production of article of thing in Andhra Pradesh or Telangana, where it acquires and installs new assets for that undertaking during the period from April 50 to March 2020. The new asset definition is primarily the same as for investment allowance, and you have that similar provision that if the new asset is sold or transferred within 5 years of installation, except on an amalgamation, demerger or reorganization, the deduction which had been allowed would be deemed to be the income of that undertaking in the year of transfer, sale or transfer. Now, interestingly, what will happen is, therefore, and this is in addition to the investment allowance which is available under Section 32AC. So, if you have an industrial undertaking which is set up in Andhra Pradesh or Telangana on or after 1st April 2015, and it acquires assets of say more than 25 crores, then what will happen is you will get the normal depreciation of 15%. You will get the additional depreciation of 35% under the first proviso to Section 32(1)(2)(8). You will get the investment allowance under 32AC of 15%. And so you will get a total of 80% is what you will get effectively. That is the position so far. And therefore it seems to be a very attractive proposition, because commercially whether those units will be viable after this investment allowance period is over is something which I think is anybody's guess. That's the problem. The next amendment I'll deal with is on this consolidation of mutual fund schemes, where the provision is basically that if units of a mutual fund scheme are received in exchange of units of another scheme, and where two or more similar schemes are consolidated under the SEBI mutual fund regulations, the transfer would be exempt. The period of holding would include period of holding of the earlier units, and the cost of the earlier units would have to be taken. And they said that similar schemes means either both are equity-oriented schemes or both are non-equity-oriented schemes. Now, if you look at Regulation 1815A of the SEBI Mutual Fund Regulations, it is nowhere talks of the SEBI Mutual Fund Regulations nowhere talk of consolidation. In Rights and Obligations of Trustees, in Regulation 18, in 15A they say that trustees shall ensure that no change in fundamental attributes of scheme shall be carried out unless a written communication about proposed changes sent each unit holder and advertisement given in English and local newspaper, and unit holders are given an option to exit at the prevailing NAV without the exit load. But if you look at the SEBI Master Circular on mutual funds, that is where you find that you have a separate section on consolidation of mutual fund schemes. And there they say that consolidation or merger of mutual fund schemes shall be regarded as a change in the fundamental attributes of the scheme. It will require board approval of both the AMC as well as the trustees of the mutual fund. They said it would not amount to a change in fundamental attributes of the scheme if the following conditions are met: that the fundamental attributes of the surviving scheme do not change, that is the scheme into which the merger takes place, and mutual funds are able to demonstrate that the circumstances merit merger or consolidation schemes and interest of unit holders of the surviving scheme is not adversely affected. So effectively what you have is really, so far as any consolidation can only take place under the SEBI MF regulations firstly. So therefore, if there is a consolidation of two schemes, now what's consolidation really? You have there are two concepts. One is a merger of mutual funds. So one mutual fund buys out another mutual fund. For instance, your elective mutual fund bought out Fidelity. Now there what happens is, it's only that the trustee company and the asset management company are changed. Those schemes, the same scheme continue, but the names of the schemes are changed.